Hi, and thanks for joining us for another video here at Street Smart Options. I'm Jim Bunker, and I'm here with Jonathan Sherman. Today, we're going to be talking about options trading for beginners. And folks, many times we get questions on our YouTube account. So if you're here and you want to subscribe, please do that. You can always leave us some questions in the comment section. And you can also find us on our Facebook group, folks. That's Street Smart Options on Facebook. Just do a quick search for SSO, Street Smart Options on Facebook. So again, today we're talking about options trading for beginners. And unlike a lot of our other videos, we're actually not going to be pulling up charts and showing you a trade today. We're going to be talking about how it's done. And as I said, we've got several different types of trading that we do. But what we're going to be looking at today is just how would this impact a beginner, someone who has never traded before and wants to learn how to trade. So Jonathan's going to take us through those steps. Go ahead, Jonathan.
Thanks, Jim. Yeah, so options are a little bit confusing oftentimes to beginners. They can understand what a stock is, and a stock is just simply ownership in a company, and a stock goes in just two directions, up or down. Whereas an option is part of a class of securities called derivatives, and a derivative is simply something whose price and performance depends on something else. And in this case, options depend on the underlying, and the underlying we're using is stocks. Options can also be traded on other derivatives like futures and commodities and things like that. But we're looking at stock options, and so an option is, the book definition of an option is a contract between two parties in which the stock option buyer or the holder purchases the right but not the obligation to buy or to sell 100 shares of an underlying stock at a predetermined price from or to the option seller, which is the writer, within a fixed period of time. And that sounds kind of confusing, right? What is all that? Well, it's basically an instrument for people that want to have a higher return on a security than what a stock can offer, and also somebody that wants to limit their risk. You can use different option trading strategies to limit your risk. So it's an agreement between two parties where the buyer buys a option with the understanding that if the underlying, in a case of a call option, if the underlying goes up, they will make a profit, and that profit's going to be determined by what the strike price is of the option. So, for example, we have in front of us here the call and put ladder for Visa company. And I'm going to go through these little columns here, and you can get a sense for what these things are. So on the left-hand side here, we have the call options, and on the right-hand side, we have the put options. And in the middle, we have the strike. So the underlying is the Visa company, right? The credit card company. And so the stock itself is trading at 144.78. Now this is a Sunday, and so this isn't going to change, but on a trading day, this would be fluctuating, and these prices would be fluctuating some too. So it's selling for 144.78. So the strike price, for example, let's look at the 144. Well, the 144 is actually in the money on the call side by 78 cents, 144 minus 144.78. Whereas the puts are out of the money by 78 cents. So actually, if these things went to expiration, if on the day that these options expire, the puts would expire worthless, whereas the call would expire with 78 cents profit. Now, options have things that kind of define them. They have the strike price, which determines how they're going to trade on the day of expiration, and then they have the expiration, which is the day that they stop trading. And if they're in the money, they stop trading with a profit. If they're out of the money, they stop trading at a price of zero. And then the other thing is they also have the the day of expiration. So they expire on different days. So we're looking here, today's the 17th of February. So we're looking here at 5 days till expiration. And then there's all these different expiration periods. This particular security has weekly options. So you have the February, you have the March, you have the April, March 8th, March 15th. And then also the regular options expire monthly, and those expire on the third Friday of every month. And so you have the weekly options, and then you have the regular options that expire on the third Friday of every month. So that's kind of just give you a taste of what options are about. Now, call options benefit when the underlying goes up in value. So, for example, if you were to buy this 144 call and you would pay the bid, which is so you would pay the ask, which is the higher price, which is 172 for this option, and if the option trades to 140 to 150, say, on expiration, which is in 5 days, you'll be up $6 in it. Now you can sell this thing anytime before expiration, and if you notice, even though it's a 144 strike and the stock is 144.78, the option is not 78 cents. The option here is the ask is 172 if you were to buy it. And why is it more than 78 cents? Well, there's a built-in premium for the time value left in this stock option. So this option expires in 5 days, and so there's a time value that is going down every day. And right now there's a time value built in, so it's 78 cents minus $1.72. So you do the math, and it comes out to 96 cents. So is that, if I did my math right, 94 cents. So so there's a time value of 94 cents in this option right here. Now on the put side, if this was to trade, let's look at the 150 strikes. Now the 150 strike put is in the money. It's in the money by 150 minus 144.78. So it's about $5.22. So you'll notice that there's a bid and ask here, and you'll notice that because only 5 days left in trading, there isn't a whole lot of time premium in this put option. And in fact, it looks like you could sell, it has a bid of $5. Well, you wouldn't want to sell it for just $5 because the actual option is worth more than that. It's worth $5.22. So you could put a limit order in if you own this thing to sell it at least $5.22, which is between the bid and ask. And in fact, when you trade these things, you don't normally hit the bid or hit the ask. If you're buying it, you're going to put a bid somewhere between here, like the midpoint, or if you're going to sell it, you're going to try to hit the midpoint between these two, the bid and ask here. So, that gives you a little bit more sense for how these things trade. Now, intraday, as these things are moving up and down, say the stock price goes from 144.78 to 146, you'll see intraday that the bid and ask prices adjust intraday, and they'll be going up in value as the stock price goes up. And that time premium will go to zero as the expiration gets closer and closer. So there's a couple of concepts then called moneyness. And moneyness, you can have you're basically in the money if the stock is selling for, in the case of a call option, higher than the strike price, and you're out of the money if the underlying the stock is selling for under the stock price. And it's the opposite with puts. With puts, you're counting on the stock going down in value. And so if the stock is selling higher than your strike price, then you're out of the money. And if the stock is selling for lower than your strike price, then you are in the money. So that is the deal with puts. And you're at the money if the strike price and the stock are selling for the same. So, why are options attractive? Why do people get involved in options? Well, options offer the ability to, first of all, leverage your capital so that, for example, if you were to buy 100 shares of a $100 stock, you're going to be spending $10,000 to do that. But if you were to buy an option, you could spend a lot less than that and control 100 shares. So for example, in the case of Visa they're sitting here right now, if we were to buy the 140 call, we're controlling 100 shares of that, but the 140 call is only going to cost us at most 525 for the February's, right? Of course, that expires in 5 days, so that is going to be, it will stop trading on February 22nd. But if we were to look like a month out, that's 26 days, then we would have a lot more time where we could benefit if the stock price goes up. But we'd spend a lot less money. So for example, the 140s here at 630, they have to multiply that by 100, so that's $630. So instead of spending $14,000 for 100 shares, you're only spending $630 and controlling 100 shares. And so you get this leverage effect. Now, leverage, of course, works both ways. If this price goes down and this thing sells, if the stock price goes down and at expiration you are out of the money, this is going to be zero. So you can actually lose your entire investment with stock options with just having a kind of a naked position, which is basically a position where you're just long a call or long a put. Your risk is limited to what you put out, but it's your entire investment, right? $630. Whereas if you own the stock outright, you would have $14,000, and if it went down $5, you're not going to be out your $14,000. You'll just be out, 5 times 100 or $500, right? So that is, it's a two-sided sword when you're talking about leverage. But you can also control your risk, and this gets a little more complicated, more it's kind of a higher level than a beginner subject. But if you could, for example, buy the 100 call, the 140 call here, and then you could sell the 145. And so then you're actually your risk once again is what you're out of pocket, but there's a difference between those, because you bought this 140 but for $630, but you sold this for $280, or actually $272. You subtract that, and so your out of pocket is $630 minus $272, and so now you've actually cut your risk from $630 to whatever the difference is between $630 and $272. And once again, you'd be using the midpoints in here, but you can reduce your risk by doing some strategies with multiple levels of options. And I'm not going to get into all that because it's more of an advanced topic. And so that is basically the some of the details behind options and options trading for beginners.
All right, thanks, Jonathan. So, folks, again, if you're not a member of our Facebook group over at Facebook, you can definitely find us there as Street Smart Options and join up. You should also be a subscriber on our YouTube channel. If you're watching right now, please do us a favor and hit that subscribe button. Also hit that bell icon so you don't miss any other timely videos that we make, just like this one, that are going to help you learn. So keep in mind, at Street Smart Options, we have everything that you'll need to learn how to trade as a beginner. And we also are able to help you with our own proprietary trading methods if you're an advanced trader. So either if you're just getting started or if you've been trading for a while, give us a look over at streetsmartoptions.com. Thanks, and we'll see you on the next video.